Hello, this is Paul Gibson with the Academy of Trading and Investing. I'm the author of the book Notes from a Profitable Investor. We'd like to begin this training with the introduction chapter of the book Notes from a Profitable Investor. If you follow the training and have a coach could be very, very helpful to you to accelerate your ability to assimilate these ideas and be able to use them profitably. Nevertheless, the lessons are designed to take you through the steps of learning how to be an investor, and these videos are designed to help you go through the chapters and lessons very quickly. Note that there are exercises to be completed with the chapter and the video, so please don't hesitate to fill those out. You'll learn a lot more and it will retain it a lot better if you do complete the exercises. So let's talk about the market. The market is a volatile place. As you've heard about bears and bulls before, bullish market is when the market is running up, the values are going upward. Bearish market is when the market is stagnant or going down. That's called volatility, the movement of the market. And the more volatile the market is, the more likely and profitably we can make money on the market. When the market's not very volatile, it's safer to invest, but we don't make much money. So there is a relationship between volatility and profitability and risk. All those things go together. So whenever you think about volatility, you have to recognize that it means risk and profit. And risk can equal profit, or in other words, the more risk you take, the more profit you're going to make. Now, that doesn't mean that you want to take lots of risk, because lots of risk can equate to disaster as well. So just be aware that the market is a very volatile place, but it can be managed. And if we learn the tools and skills necessary to work with the market, we can be successful to a very high percentage. So, we want to know what we're doing. This is from the prologue. Despite what the analysts and pundits would have you believe, the market movement is not dependent on the economy or on political issues. The market responds to investor sentiment. In other words, things could be terrible economically and politically, but the market could still move upward in value, or it could go down, depending on what the majority of the investors are thinking about how to invest their money. Interestingly enough, 90% roughly of the market is driven by the institutions. 10% roughly is driven by individual investors. This information comes from J.P. Morgan on CNBC. If you want to check that out, you're welcome to. There's lots of different opinions about those statistics, but they're roughly true. So we want to develop some rules for investing. A savvy investor will recognize that rule number one needs to be, let's preserve capital. In other words, let's protect ourselves. We don't want to take extraordinary risks. We only take the risks that are necessary to be able to help us move towards our goal. We want to be careful not to lose our hard-earned money. Investing is not like gambling. In gambling, the odds are against you. If you know what you're doing, you place the odds of success in your favor. That's called investing. So what is your plan? I think it's necessary to have a pretty well-defined plan. It doesn't have to be mathematical so much. It doesn't have to be super sophisticated. You don't have to be a rocket scientist or a genius to develop a plan. It can be certainly just a set of rules and policies and steps and procedures that you can follow, that you can develop on your own. We'll help you develop the ideas and learn the ideas that go behind that, but then you would develop your own ideas on how to execute on those ideas. So the first place we want to start is vision and goals. What is it you're trying to accomplish? For example, if you have a lot of money, it would make sense to minimize risk and then just seek to expand on that capital in a safe and organized way. If you don't have a lot of money and you need to make up some ground, obviously you will need to take more risk. But it still can be done in an organized way that can minimize risk somewhat, but you would still be wanting and needing to make more money as you go forward, because you're trying to catch up for lost ground. So what are the strategies? What are the tools and ideas that you will want to use to address market conditions and to place your investments? Market condition understanding is very important. We want to understand what's going on in the market, and we want to understand the tools and ideas necessary to place our investments and be profitable. Thirdly, we want to practice, practice, practice. We want to master our tools in a virtual environment to a high level of competency before we start to trade. Then we want to trade with discipline, keeping to our rules, be flexible when necessary, and change up the tools depending on the market conditions. It's awfully easy to become emotional about our trades and let fear or greed govern us. And believe me, I have done both. Gotten out of trades too early, or hesitated from doing a trade, or gotten greedy and gotten into a trade I should not have gotten into. Those have been great learning experiences, but it's empowered me and sunk that concept deeply into my heart that I just need to be consistent with my trades. Be flexible, of course, use different tools as necessary to complete our trades, but nevertheless, wanting to be very disciplined and careful and regimented in the way we go about our trading will be much more successful, much more frequently and consistently if we will exercise that discipline. So, another tip is we want to keep good records. I suggest that you get a notebook or a binder or a virtual file of some sort that you can create. One for your rules of trading and for taking notes. We want to have those rules written down in a place that's easily accessed. That way we can reference them. I know experienced traders that always still go back to their rule book to make sure that they're making their trades in an appropriate way. It becomes more of a checklist for them. They can just ask themselves, have I done this? Have I done that? Did I look at that particular issue? To make sure that they're making correctly decided investments in a way that's going to be consistent with their rules and with their goals and their risk tolerance. The second book would be one where we would keep track of our trades. Your broker will have record of your finished transactions, but I strongly suggest that you keep track of what you were thinking when you made the trade. Perhaps a screen print or a picture of the stock chart at the time you made the trade, including your own indicators and some of your own notes about the market, economy, politics, and anything else that you might know that influenced your thinking about the trade at that time. So here's an example of my notes. As you can see, we have a stock chart here. This happens to be just of the Dow. And I have all of my indicators mapped out here. These are candlesticks. Then I have the indicators of the Bollinger Bands and the exponential moving averages. Of course, volumes across the bottom here. And we have the stochastic RSI across the bottom, as well as the MACD. You want to be able to understand what these things are telling you. This is a language that we can learn, and it's a craft that we can understand. And then, of course, I've made my own notes about what I'm observing and some comments about the technical analysis going on here. This kind of thing can be very, very simple. You can write this down, punch holes in it, put it in a binder, or save your document to the cloud or whatever source you want to put it in. That way you've got a reference. So at the end of your trade, you can go back and look at your beginning point, which is this analysis, and ask yourself, how well did that turn out? Was I correct in my assumptions about the future based on my analysis of the current situation? This is a great way to study. You may find that you're being too aggressive or not aggressive enough in your analysis. And that way we can tweak our attitudes and we can tweak the way we're thinking, and perhaps using different skills and tools, we may find that we want to add an additional concept or oscillator to our evaluation. Or perhaps we find that one of our oscillators we just don't need to consider because it's not helping us that much. And that way we can fine-tune our process over time. Once again, the most experienced traders I know are constantly looking at their tools and evaluating what's working and what's not working. In some situations, they'll use specific tools. In other situations, they'll eliminate those tools because the market conditions are different than the first set of tools. So don't be afraid to change up and be flexible. We just don't want to be changing up too often because that causes erratic behavior. We want to be consistent enough that we can measure what it is we're doing and see how successful we are with our current set of strategies. We also want to have a trading plan that's written down. So here's a sample of things that could be in a trading plan. So for our bull flags sample investing plan, we'll want to take a look at the technical analysis. And here this person has an exponential moving average and he likes to use a 4, 8, 50, and 200. He also likes to look at the Bollinger Bands, the stochastic RSI, on-balance volume, and the MACD. That may sound complicated, but once you see it all in the picture, as we saw on the last slide, you'll see that it really does become just a great picture that we can look at. Next, we can take a look at our objectives. What is it we're trying to accomplish with this trade? Does it match our overall global strategy? We can also then take a look at our entry rules. Under what conditions would we want to enter a trade? How do we manage our money? An example of that would be that one of my favorite investor colleagues likes to take half his profits when he reaches a certain point. Then he will forestall and take the rest of his profits when he feels like the transaction has topped out for profitability. That way he can recover money as he goes along and perhaps minimize some of his expenses. We also want to have some exit rules. When and how do we get out of a trade? There are many different ideas on how to do that, and we'll get into that later as we get into future chapters, which I think you'll enjoy. Entry rules and exit rules. We also want to develop some routines. Perhaps sample weekly routine would be to check on the market status 2 or 3 times a week and look for weekly trades. Or it could be something more on a quarterly basis or a monthly basis, just depending on what you want to do, but we want to establish what those routines are, when to get involved, and make sure that we keep to the discipline pretty much the way that we can. Of course, there's some flexibility in the market. There may be times when you can't invest or the market doesn't indicate that you should be investing. There are other times when there are some great opportunities in the market or you have additional time that you want to put into your investing process. So once again, this is Paul Gibson with the Academy of Trading Investing. Please know that there will be many opportunities in the future. If you would like to be prepared, let's get educated now. If you'd like, for help and study on these concepts and investing techniques, check out our website, www.academyofti.org. There are a lot of great articles in the libraries there, some videos that can be very helpful to you. We're here just to help. If you want, we also have coaches available to you that will accelerate and maximize your profits as you work through this investing process or the education for that. Also, as you're studying now, you'll probably purchase the book, Notes from a Profitable Investor, How to Invest the Stock Market. It's available on Amazon.com and also on Amazon Kindle. We'll look forward to talking with you in the next lesson.